you get inflation, and the dollar crumbles, and gold maintains its purchasing power. So that's the beauty of gold. This is why it's such a great investment.
Cleta Smith says most of those comparisons of gold maintaining its purchasing power historically occurred when the dollar was the reserve currency. But what happens should the dollar cease being the world's reserve currency? When it loses that status, will it be devalued substantially, so its buying power will plummet? So will gold just retain its value in the new world reserve currency, or will it demonstrate a outstanding benefit over the devalued dollars, or just maintain its buying power?
Well, it depends how you measure it. You're measuring gold in dollars. Gold's going to soar in dollar terms. Dollar's falling, you get inflation, and the dollar crumbles, and gold maintains its purchasing power. So that's the beauty of gold. This is why it's such a great investment. And you always should have at least 5% of your net worth in gold. And it's a parking place for your wealth. It's not really even an investment. Investment is something that returns an after tax, after inflation, real return. That's not what you use gold for. That's what gold miners can do. That's an investment. Gold is used to preserve your purchasing power. So as the dollar crumbles and inflation ticks higher here in some kind of future stagflationary environment, which is, by the way, where I think we're headed in the out years, middle of this decade and beyond, severe, trenchant, protracted stagflation is, I think, what the U.S. is in store for. Gold's going to be fantastic. But as far as giving you a return over inflation, no. It is a parking place of your wealth. It's a way of preserving your purchasing power, period.
Well, you described the Fed's actions as, or they need to get really hawkish against inflation, but it's people who have been talking about the real rate of inflation being significantly north of where the Fed's actions have been in response seem to say that the Fed's response is far from hawkish. Can you talk to us about whether you think that their fractional percent increases in interest rates that they've been doing are going to be meaningful at doing anything to tamp down real inflation?
Well, yes. I mean, I do believe inflation is in the process of peaking. I believe we're going to have a period of disinflation. I mean, I'm not arguing that prices are coming back down to where they were pre-pandemic. And you have to define what inflation is. It's rate of change. It's the first derivative. I'm saying the second derivative of that change is going to be lower than it was in the last print of 9.1%. That's all I'm saying. So inflation going from 9.1 to 7 something percent, perhaps by the end of this year, is disinflation. It's not deflation. It's not falling prices. It's prices that are rising at a slower rate. That's a fact, in my opinion. That's what's going to happen. And the reason why it's going to happen is look at the growth rate of money supply. M2, the growth rate of M2 is crashing. And the government stimulus checks have stopped arriving in the mail for the most part. You have some ancillary states, I think there's 15 states sending relatively smaller amounts of stimulus, but that doesn't counteract the fact that the Fed is going from 0% Fed funds rate to 3.25% to 3.5% by this year. Now that's a pretty significant rate of change on interest rates, no matter how you slice it. Okay, 350 basis points in 1 year is a whole heck of a lot. I don't care if you're talking about Jerome Powell or Paul Volcker. And on a percentage basis, it's the fastest rate of change we've ever seen before. And on top of that, what we're supposed to be seeing, and I am not trusting this, I am distrusting it, but verifying it, is I want to see the balance sheet being reduced as to the level and pace that Jerome Powell said he was going to reduce the balance sheet. Balance sheet so far has had very little reduction. Maybe I think $50 billion from the high. It's supposed to be $47.5 billion per month. This was supposed to start in June. We are now in August. So there's something going on. In fact, here's what I wanted to say. This is such an important point. I doubt you hear this anywhere else because Wall Street is made up of a bunch of cheerleaders. But listen to Powell's press conference, he was actually asked a question about the balance sheet. And what he said was, he gave us some gobbledygook about trade settling, but he said it's about to ramp up significantly. It's going to jump to $95 billion a month in September. And then he said this in response to a reporter's question. He said that the balance sheet will take 2 to 2.5 years before it reaches equilibrium. QT will have a duration of 2 to 2.5 years at the pace of $95 billion a month before the balance sheet reaches equilibrium. That's from his mouth. Now, I'm mistrusting and verifying. But if that's the case, if we're going to go to 3.25% to 3.5%, right now the effective Fed funds rate is I think it's 2.3 right now, effective Fed funds rate. If we're going to go from 2.3, 2.2 and a quarter, 2.3 to 3.25 to 3.5, plus drain almost $500 billion of money supply between now and the end of the year, that is the most hawkish central bank in history, and it exists in the context of, and we can debate this all you want, but in what we have to agree on is a very weak U.S. economy and an extremely weak global economy. Don't forget, we have Bank of England saying today that we're going to have a recession throughout all of 2023. GDP in the Eurozone is slated to contract later this year. Japan is contracting. The U.S. is contracting. China's manufacturing base is contracting. So you have a very, very weak construct and some of the most hawkish central bankers in history. If you want to fight the Fed and fight the business cycle and the liquidity cycle, you can do so and get all FOMO'd up about a bear market bounce. But for me and my investors, we are going to be patient. We're going to stay safe. We will cover shorts and go long panic bear market sell-offs, not try to get caught up in the fear of missing out.
How about the 10-year and 2-year inversion, that sort of thing? Watersport86 says, ask Michael if the Fed is purchasing the debt market. How are they doing it if it's not on their balance sheet? Speaking of the balance sheet. And if not, why is the 10-year dropping like crazy?
Well, because, like I just explained before, listen, the Fed is going to raise, Fed controls short-term interest rates. They do not control long-term interest rates unless they're actively purchasing those bonds. And we can see from the balance sheet that they are not actively purchasing long-term duration bonds any longer. So they're raising the Fed funds rate. That tends to elevate short duration treasuries, so anywhere from 0 to 3 years. And yet, because they're so aggressively fighting inflation, the longer end of the yield curve, which is most concerned about growth and inflation, is saying, hey, we are headed for a period of, on the second derivative basis, slowing inflation, disinflation, and a recession. So people crowd into the longer end of the yield curve. And the yield curve right now is more inverted today. I think it's 35 basis points, depending on the moment you look at it. Negative 35 basis points between the 2-year and 10-year note is more inverted than it was at any time leading up to the global financial crisis, just before the global financial crisis. So you have a very inverted yield curve. It's becoming more deeply inverted, and it's presaging recession and disinflation. Not deflation yet, disinflation.